Let me tell you something that the financial industry doesn't want you to know. Private equity has become one of the biggest scams in modern finance. I know that's a strong statement. I know it's going to make me enemies. But I've been in this business long enough to see how the game really works. And what I've seen disgusts me. My name is Kevin O'Leary, and I built companies, sold them, invested in hundreds of businesses, and worked with some of the largest institutional investors in the world. And I'm here to tell you the truth about private equity. The truth that nobody else will say out loud because they're all making too much money from the lie. Private equity firms are extracting billions of dollars from pension funds, endowments, and institutional investors through fee structures that are fundamentally dishonest. They're presenting returns that are calculated in ways that would make a used car salesman blush. They're selling a product that doesn't deliver what it promises, but they've gotten so good at the sales pitch that even sophisticated investors keep writing checks. Today, I'm going to break down exactly how this scam works, why it persists, and what you need to know to protect yourself or your organization from becoming the next victim. Because make no mistake, this is one of the biggest wealth transfers in financial history, and it's all happening behind closed doors, in unmarked returns, in fee structures that nobody fully understands. Let me start by explaining what private equity is supposed to be versus what it actually is. In theory, private equity is simple. A fund raises money from investors, uses that money to buy companies, improves those companies, and then sells them for a profit. The investors get their money back plus a share of the profits. Sounds reasonable, right? Sounds like a legitimate investment strategy. But here's where the theory diverges from reality. And it diverges in ways that are specifically designed to enrich the private equity managers at the expense of their investors. The first problem is the fee structure, and this is where the dishonesty really begins. Most private equity funds charge what's called a 2 and 20 fee structure, 2% management fee on committed capital and 20% of the profits. Now, on the surface, that might not sound outrageous. After all, hedge funds charge similar fees. But here's what most people don't understand about how those fees actually work in practice. Let's say a private equity fund raises $10 billion. That 2% management fee means they're collecting $200 million per year, every year, regardless of whether they make any money for their investors. $200 million just for showing up. Now, you might think, okay, but they have expenses. They need to pay their staff, rent offices, do due diligence on potential investments. Sure, but do you know what the actual operating expenses of a typical private equity fund are? Maybe $50 million, maybe $75 million if they're running a really high quality operation. So what happens to the other $125 to $150 million? It goes straight into the pockets of the fund managers. This is fee revenue that has nothing to do with performance, nothing to do with generating returns for investors. It's just pure wealth extraction based on the size of the fund. But it gets worse, much worse. Private equity funds don't actually take all the money up front. They call it as they need it for deals, so you commit $10 billion, but they might only call $2 billion in the first year. But guess what? They charge the management fee on the full $10 billion. Not on the $2 billion they're actually using. On the full $10 billion you've committed. So you've got $8 billion sitting in treasury bills earning basically nothing, but you're paying 2% on that $8 billion to the private equity fund. That's $160 million in fees on money they're not even using. Money that's earning you maybe 1 or 2% in T-bills while you're paying them 2% to not use it. The math doesn't work. But the fee structure is set up this way deliberately because it maximizes what the fund managers can extract. Now let's talk about how returns are calculated, because this is where things get really dishonest. Private equity funds report something called internal rate of return, or IRR. And on paper, these IRRs often look fantastic. 15%, 18%, 20% annualized returns. Wow, you might think. That's amazing performance. Way better than the stock market. But here's what they're not telling you about how that IRR is calculated. IRR is extremely sensitive to timing. If a fund calls your capital late and returns it early, the IRR looks great even if the absolute return is mediocre. Let me give you a concrete example. Let's say a fund commits to invest $10 million of your money, but they don't call that money for 3 years. Then they invest it. hold it for 2 years, and return $12 million to you. In absolute terms, you made $2 million on $10 million. A 20% total return, not bad, but nothing special. But the IRR on that investment looks spectacular, because from the time they actually called your money to the time they returned, it was only 2 years. So it looks like you made 20% in 2 years, which annualizes to about 9.5%. But wait, there's more manipulation, because they didn't just hold your money in cash for those first 3 years. They charged you fees on it. So your actual return is significantly lower than that IRR suggests. But when they report their performance, they trumpet that 9.5% IRR. They don't tell you that you could have just put that money in an index fund 5 years ago and probably done better. This is fundamentally dishonest. It's presenting returns in a way that's designed to mislead investors about the actual performance, but the dishonesty doesn't stop there. Let's talk about how private equity funds value their holdings. Unlike stocks, which are marked to market every day, private equity funds hold private companies that don't have public market prices. So they get to decide what those companies are worth. They get to mark their own homework. And guess what? They always mark their holdings at values that make their performance look good. Always. They use something called comparable company analysis. They look at similar public companies, apply those valuations to their portfolio companies, and voila, their fund shows great returns, except they're incredibly selective about which comparable companies they choose. They always choose the ones with the highest valuations. They ignore the ones that would suggest their portfolio companies are worth less. This is legal, but it's dishonest, because they're creating the appearance of returns that haven't been realized yet, returns that might never be realized. I've seen pension funds report great performance from their private equity allocations. Then when the funds actually liquidate and return cash, the actual returns are much lower than what was being reported for years. But by that time, the fund managers have already collected hundreds of millions in fees based on those inflated valuations. Let me share a story that illustrates how this works in practice. I was talking to a pension fund manager a few years ago, and they were telling me about their private equity allocation. They had committed $500 million to various private equity funds. On paper, those investments were showing returns of 15 to 18% per year. Way better than their public equity portfolio. I asked them, how much cash have you actually received back from these investments? How much has actually been returned to the fund? They looked uncomfortable. They said, well, most of these are still in the investment period, so we haven't received much cash back yet. I said, okay, but the ones that have been liquidated, what were the actual returns? Not the IRR, not the marked valuations, but the actual cash-on-cash return. More uncomfortable silence. Then they admitted that the few investments that had actually been liquidated had returned about 8 to 10% total over periods of 7 to 10 years. So the actual returns were barely beating the stock market, if at all. But on paper, while the investments were still being held, they looked fantastic. This is the game. Inflate the marks while you're holding the assets. Collect massive fees based on those inflated marks. Then when you finally sell, the actual returns are mediocre, but by then nobody's paying attention anymore. The fees have already been collected. Now let me talk about another aspect of private equity dishonesty that really bothers me. Transaction fees. Private equity funds don't just charge management fees and take a cut of profits. They also charge fees for every transaction they do. They charge the companies. They buy a fee for buying them. They charge a monitoring fee every year for overseeing the company. They charge a fee when they sell the company. These fees go directly to the private equity firm, not to the fund. So they're not shared with investors at all. This creates a perverse incentive. The fund managers make money from fees regardless of whether the investment actually generates returns. I've seen cases where a private equity fund bought a company, loaded it up with debt, extracted millions in transaction fees and dividends, then sold the company for barely more than they paid for it. The investors in the fund barely broke even after all the fees. But the fund managers made a fortune from all the transaction fees they extracted along the way. This is what I call heads I win, tails you lose. The fund managers get rich no matter what. The investors only make money if the investments actually work out, and often they don't. Let me tell you about the leverage game that private equity plays, because this is another area where the dishonesty becomes really clear. Private equity funds love leverage. They buy companies and immediately load them up with massive amounts of debt. Why? Because leverage amplifies returns. If you buy a company for $100 million with $50 million of equity and $50 million of debt, and you sell it for $150 million, you've made $50 million on a $50 million investment, a 100% return on your equity. If you'd bought the same company with $100 million of equity and no debt, you'd have made $50 million on $100 million, a 50% return. So leverage makes the returns look better. And since private equity firms are evaluated on their returns, they have every incentive to use as much leverage as possible. But here's the problem. That leverage doesn't belong to the private equity fund. It belongs to the company, which means it creates risk for the employees, the suppliers, the customers, and ultimately for the broader economy. Private equity doesn't bear the risk of that leverage. They've already collected their fees. If the company goes bankrupt under the weight of all that debt, the private equity fund might lose their equity investment, but they've already extracted millions in fees along the way. I've watched private equity firms buy perfectly good companies, load them with debt to pay themselves dividends, then drive those companies into bankruptcy while the fund managers walk away rich. This happened with Toys R Us. This happened with countless retailers. This happened with nursing homes and hospitals and media companies. The pattern is always the same. Buy with leverage. Extract fees. Leave the company unable to invest in its business because all the cash flow is going to debt service, then walk away when it collapses. This is legal, but it's not honest. Because when they're selling investors on these deals, they're not saying, we're going to strip mine this company for fees and leave it to die. They're saying, we're going to create value through operational improvements. Let me address another dishonest practice that's become endemic in private equity: the use of continuation funds. This is a new trick that's become popular in recent years. Here's how it works. A private equity fund is supposed to have a finite life, usually 10 years, sometimes extended to 12 or 13. At the end of that period, they're supposed to sell all their companies and return the cash to investors. But what if they don't want to sell? What if the market isn't good, or they think the company will be worth more later, in the past? Tough luck. You had to sell anyway. That was part of the deal with investors. But now, private equity funds have found a loophole. They create a continuation fund. They transfer the company from the old fund to a new fund at a negotiated price. Existing investors can choose to either cash out at that price or roll their investment into the new fund. Sounds reasonable, right? But here's the dishonesty. Who sets the price for that transfer? The private equity firm. Who benefits if the price is set high? The private equity firm, because it makes their returns on the old fund look better and they get to charge a whole new set of fees on the new fund. Investors who want to cash out get paid a price that might be inflated. Investors who roll over are stuck in a new fund with new fees and no guarantee that the company will actually be worth what it was transferred for. And the private equity firm? They get to restart the fee clock and collect another decade of management fees on the same asset. This is the kind of financial engineering that benefits fund managers at the expense of investors. But it's become standard practice in the industry. Now let me talk about something that really drives me crazy: the salesmanship versus the substance. Private equity firms spend enormous resources on marketing. They produce glossy presentations. They hire prestigious consultants to validate their strategies. They wine and dine pension fund trustees and endowment boards. They're incredible salespeople, some of the best I've ever seen. But when you actually dig into the numbers, when you look at the real cash-on-cash returns after all fees, the performance often doesn't justify the hype. There was a study done a few years ago that looked at private equity returns over a 20-year period. When you adjust for risk and fees, private equity barely outperformed public markets. And in many vintages, it underperformed. But private equity firms have raised more and more money every year because they're great at selling the dream. They sell the idea of superior returns. They sell access to exclusive deals. They sell the notion that you need alternatives in your portfolio, and institutional investors buy it, even when the evidence suggests they shouldn't. I've had trustees from pension funds tell me they know their private equity allocation probably isn't adding much value after fees. But they invest anyway because everybody else is doing it, because it looks sophisticated, because they don't want to be the one who missed out if it does work. This is herd mentality, replacing fiduciary duty, and it's costing retirees and beneficiaries billions of dollars. Let me share what Warren Buffett and Charlie Munger have said about private equity, because I think they nail it. Buffett has said that if you commit capital to a private equity fund, they charge you fees on that committed capital even before they use it. So you're paying fees on money sitting in treasury bills earning nothing. Then, when they calculate returns, they don't count those years when your money was sitting idle. They only count from when they actually deployed the capital. So the IRR looks great, but your actual return over the full period is mediocre. Munger told a story about a horse that was wonderful most of the time, but occasionally went crazy and caused enormous damage. The owner asked the vet what to do. The vet said it's simple. Next time the horse is behaving well, sell it. Munger said that's exactly what private equity has to do. When they have a good company, they have to sell it to someone else, even if holding it longer would create more value, because they have to show returns to raise their next fund. This short-term thinking is built into the business model, but it's completely contrary to how you should invest for long-term wealth creation. Now let me talk about why this matters. Why should you care if private equity is dishonest? Because if you have a pension, if you have money in an endowment, if you're a beneficiary of any institutional fund, your retirement is being impacted by these fees and these dishonest practices. Let's do some math. Let's say a pension fund has $1 billion. They allocate 20% to private equity, $200 million. Over 10 years, that private equity allocation generates a 15% IRR. Sounds great, right? But let's look at what that actually means in terms of fees and net returns. The private equity fund charges 2% on committed capital. So that's $4 million per year in management fees. Over 10 years, that's $40 million in fees. Then they take 20% of profits. If the investments do well, that could be another 30 to 40 million in carried interest. So total fees might be 70 to 80 million dollars on that $200 million allocation. Meanwhile, if that same 200 million had been invested in a low-cost index fund, the total fees over 10 years would be maybe $2 to $3 million. The difference in fees is $75 million. That's $75 million that could have gone to retirees. Instead, it went to private equity managers. And that's assuming the private equity actually delivered better returns than the index fund, which, as I've explained, often doesn't happen once you account for all the fee manipulation and inflated valuations. This is money being extracted from people who work their whole lives and are depending on their pensions for retirement. And it's going to enrich fund managers who are already worth hundreds of millions of dollars. That's why this matters. That's why the dishonesty in private equity is more than just an academic concern. It's a moral issue. Now, let me address the defense that private equity firms always make when challenged on these points. They say, we're providing access to investments that aren't available in public markets. We're creating value through operational improvements. We're delivering diversification. Let me address each of these claims. Access to private companies. Is that really valuable? Public markets have thousands of companies across every sector and size. If you want exposure to small companies, you can buy small cap funds. If you want exposure to certain industries, you can buy sector funds. The idea that you need private equity to access investment opportunities is mostly a myth, especially when you consider that private equity firms often buy public companies and take them private. So the company was available to public investors, but now only the private equity firm can own it, and they're charging you $2 and $20 for the privilege. Operational improvements. This is the biggest myth of all. Private equity firms claim they add value by improving the operations of the companies they buy. Sometimes this is true. They bring in new management, streamline operations, make strategic changes. But often, what they call operational improvements is just financial engineering. Loading the company with debt, cutting costs to unsustainable levels, extracting dividends that leave the company unable to invest in its future. I've seen private equity owned companies that were genuinely improved, but I've seen far more that were stripped for parts and left worse off than before. Diversification. This argument makes me laugh. You're paying 2 and 20 for diversification? You can get diversification by buying an index fund for 5 basis points. The idea that private equity provides meaningful diversification is questionable anyway. Private equity returns are highly correlated with public equity returns. When the stock market crashes, private equity values also fall. They just don't show it in their valuations because they're not marked to market. So you're not actually getting diversification. You're getting the illusion of diversification because private equity funds smooth their returns through favorable valuations. Let me tell you what I think institutional investors should do instead of allocating to private equity. First, recognize that you probably don't have an edge in private equity selection. Picking winning private equity funds is at least as hard as picking winning stocks, maybe harder, because you have less information and the performance data is less reliable. Second, understand that fees matter enormously. The difference between paying 2% and paying 20 basis points compounds dramatically over time. Those savings go straight to your beneficiaries. Third, be honest about whether your organization has the sophistication to evaluate private equity properly. Most don't. They're relying on consultants who have their own conflicts of interest. They're relying on the private equity firm's own presentations. If you can't independently verify the returns, if you can't understand all the fees, if you can't evaluate whether the risk-adjusted performance justifies the allocation, you shouldn't be investing. Fourth, ask hard questions. Demand to see actual cash-on-cash returns, not just IRR. Demand full transparency on all fees, including transaction fees. Demand to understand how valuations are determined. If the private equity firm can't or won't provide that information clearly and honestly, walk away. Fifth, consider whether you're better off just buying public equity index funds. You'll get diversification, liquidity, transparency, and low fees. Your returns might be less exciting, but they'll probably be higher after accounting for all the costs and risks of private equity. Let me share a personal story that crystallized my thinking on this. Years ago, I was invited to invest in a private equity fund run by some very smart people with impressive track records. They showed me their historical returns, impressive IRRs, great companies in the portfolio, sophisticated strategy. But I asked them to show me the actual cash that had been returned to investors. Not the valuations, not the projections, the actual cash distributions. They were reluctant to provide that information. They said it wasn't how they normally presented their performance. I insisted. Finally, they provided the data, and it told a very different story than the IRR numbers suggested. Yes, they had some big winners, but they also had some complete failures that weren't reflected in the valuation marks. And when you looked at total cash in versus total cash out across all their funds, the returns were mediocre, maybe 8 to 9% annualized over 10 to 15-year periods. Not bad, but nothing close to what the IRR numbers suggested, and certainly not worth the 2 and 20 fee structure. I passed on the investment, and I've been very selective about private equity ever since, because I learned that the presentation almost always looks better than the reality. The fees almost always consume more of the returns than they should. And the lack of transparency creates opportunities for dishonesty that many firms exploit. Now, I want to be clear about something. Not all private equity firms are dishonest. There are some high-quality firms that deliver genuine value, charge fair fees, and provide transparent reporting. But they're the exception, not the rule. And even the good ones operate in an industry structure that creates perverse incentives and opportunities for fee extraction. The problem isn't just a few bad actors. The problem is systemic. The entire business model of private equity is built on information asymmetry and fee structures that favor managers over investors. Until that fundamental structure changes, private equity will continue to be a way for fund managers to get rich at the expense of their investors. Let me end with some advice for anyone who's in a position to make or influence investment decisions for institutional funds. Your fiduciary duty is to the beneficiaries, not to the consultants who recommend private equity, not to the private equity firms who wine and dine you, not to the other trustees who think private equity makes you look sophisticated. Your duty is to maximize risk-adjusted returns for the people depending on that money for their retirement or their education or whatever the fund's purpose is. That means being skeptical. That means asking hard questions. That means demanding transparency. That means comparing actual costs and actual returns, not just the numbers that private equity firms want you to see. It means being willing to say no, being willing to be different, being willing to stick with simple, low-cost, transparent strategies, even when everyone else is chasing complex alternatives. Because at the end of the day, your job is to protect and grow the money entrusted to you, not to make private equity managers rich. The dishonesty in private equity isn't a secret. It's just that most people in the industry have an incentive to ignore it or downplay it. But you don't have to ignore it. You don't have to accept fee structures that are designed to enrich managers regardless of performance. You don't have to accept return calculations that are deliberately misleading. You have the power to demand better, to insist on honesty, to allocate capital to strategies that actually serve investors rather than extracting wealth from them. The question is whether you'll exercise that power or whether you'll keep writing checks to an industry that's gotten very good at selling a product that doesn't deliver what it promises. The choice is yours, but now you know the truth, and you can't say you weren't warned.